it obviously plays a role in terms of what's driven asset pricing low, but when you advise folks to how big of a role do you think people should allow financing to play in the underwriting of assets at this point? So.
Look, it's, Gordon said, well, fundamentally, the cost of financing and the cost of asset prices ought to be correlated in some way and over some period of time. And so I think the big bet in the real estate business today is whether interest rates will stay low for an extended period of time or whether they'll go back up. And there's a great deal of uncertainty around that. If you assume today's interest rate environment persists, and it certainly looks like it will for the foreseeable future, then in fact real estate is reasonably cheap, and taking advantage of financing on a relative basis is exceptionally attractive in terms of spread investing today. The real key to value is what are financing rates going to be in the future, of course, and that's the harder thing to predict. So, in effect, as one thinks about financing today, there's a tendency to be very quick to finance whatever you're buying, because no one wants to be stuck in the possibility that some geopolitical or macroeconomic event changes the interest rate structure of the market on short order, and we certainly live in a world of risk where that can happen. So there's a desire to very closely match fund what's being bought today, because certainly a lot of the value sits in the financing. And of course, people are looking at financing based on future cash flows, and when the debt piece of it matures, and obviously as a public company or as a private buyer, people are also looking at equity ventures or issuing equity along the way and finding the right capital stack. But the question will be, what does my asset look like in the future in terms of what the cash flow looks like at that point, and what, if you've done with permanent financing, it's a different set of issues, but if you've done it with debt financing, there has to be an eye on the exit coming out of it as to what cash flows are like to look at. Can you add the value? Is the cash flow going to be higher when the debt matures, and therefore provide a margin of safety to the extent the rate structure in the market has changed, and you can make money off the correlation in higher asset prices that might follow from that. So I think it's very much matching on the way in, and then thinking about the exit as to what the world might look like, and having a margin for error on that.
You know, Matt,